So is this year different when it comes to the saying sell in May and go away? It appears that at least for the IA plays such as Meta, Google, Nvidia, Palantir, Path, it was not a month to stay on the sidelines. Absolutely not. There's so much to cover here. This is such a great question, but let's start with data, because data always tells the truth. And sometimes there can be these old proverbs that are just there because something happened 100 years ago or 50 years ago. But let's look at the data over the last 50 years and try to figure out exactly what's going on. So sell in May stats, last 50 years. And by the way, I am an absolute student of stock market history. I've got all the numbers for all the assets going back sometimes 70, 90, 100 years. And I analyze trends by months, by years, by presidential elections. I look at all the crypto stuff too. So it's very, very important. But here are the summary stats, okay? So the average return from May to October is minus 0.2%. You can call that flat, ladies and gentlemen. And remember, that's a big window of time. May, June, July, August, September, October. That's 6 months. It's half the year. And yes, it includes some bumpy times because historically, sometimes September was absolutely horrible. And volatility and volumes are low in the summertime like August because people are away. And that has a big part of it. Now, the average return from the other half of the year, November to April, plus 7.9%. So the big takeaway just from the last 50 years of data. And I always say, don't ever not be in the market. Look at the last 50 years of data. Worst thing that can happen for a 6-month period is you'll lose minus 0.2%. And the other 6 months, you make 8%. On average, every year for the last 50 years. So for those of you who say, oh, S&P 500 isn't going to go anywhere for the next 10 years, look at history. That has the answers. In addition, the win rate from May to October, 46%. What this means is the S&P 500 rose in price on 46% of the days from May to October. That's not bad, nearly half. The win rate from November to April is 77%, a lot better. And the Sharpe ratio from May to October is 0.2. Now, the Sharpe ratio indicates that the sell in May, go away strategy has generated a low return per unit of risk, but not negative, low. And the Sharpe from November to April is 0.7, which is more positive. But both Sharpes are positive, which is good. Now, let's go and look at a couple of things as well. Very important to look at when you look. You can't just take a proverb and not dissect it. And as I always say, and this is from a deck I did like 7 or 8 months ago, invest in disruption. And this was all of my positioning related to things I've owned in the past and what I have never owned. And you can see here over the last 10-year returns, Bitcoin, Tesla, Nvidia, Netflix, Amazon, Microsoft, Apple, Google, all have astounding returns. The S&P 500 over a decade, 300%. And you can see as well, what's the last one there? Gold, plus 7% over a decade. Woohoo! As I say, I don't get out of bed for that type of return, especially not over 10 years. That's compounded less than 0.4% per year. And forget dollar debasement. The other thing that I always say, remember this, to be in the top 1%, you have to do what the 99% won't, okay? We've covered this many times. If you follow the herd, you will get nowhere. Don't mean to be blunt or harsh, but that's a fact of life. And summary, sell in May, go away is based on index. Indexes are crap, as I say. Find the winners. Now, what's also very important this year is watch the macro. We have money printing coming back and a Fed pause almost in place. Again, it's later than expected, but here we are. These are reasons for the markets to be very bullish. And again, there could be a little liquidity suck because the government has to raise 600 billion, 700. Let's just round it up to $1 trillion over the next 4 to 6 weeks, 12 weeks maximum. That will suck some money. But remember, there's $5 trillion on the sidelines that might buy these treasuries. Are people going to sell their Tesla stock to buy a US Treasury that pays 5% when the money printing over the next 2 years will be 11.6%? Nope, they're not going to, if they have a smart brain. But there are people that believe treasuries are the way to go. And again, don't follow the 99%. Be different. Think different, like Steve Jobs would say. And finally, the strategy for the S&P 500 shows that it hasn't been successful in recent years. Don't be the 99%, be me.